Net operating losses, or NOLs, are valuable corporate assets in distressed M&A transactions. In a taxable asset disposition, the seller may use NOLs, subject to potential limitations, to offset gain on the sale. In the event the seller continues to operate post-disposition, remaining NOLs may be used to offset seller's operating income and gain on eventual liquidation. The buyer in a taxable asset acquisition takes a stepped-up basis of the assets acquired, which may provide future depreciation and amortization deductions to offset income from operations. In a stock disposition, NOLs remain with the corporation the buyer acquires and are available to offset future income, subject to certain limitations. The seller in a stock deal may seek additional purchase price for the value of the NOLs the buyer can use going forward. Importantly, the NOLs at issue in a stock transaction may be not only historic, but also generated at the time of the deal. For example, compensation payments, financial advisor fees, and other transaction tax deductions can lead to a large NOL that will be carried forward and may be used during buyer's ownership of the target. What are the principal limitations on buyer's use of a target's NOLs following a stock acquisition? Internal Revenue Code Section 382 serves as the primary limitation. It provides a calculated limit on buyer's use of a target's NOLs post-acquisition in the event of an ownership change. Section 382 is backstopped by other less frequently used tax rules, including Code Section 269, which can disallow the use of NOLs in an acquisition of 50% or more of a target corporation stock if the principal purpose of the transaction is the avoidance of tax through the use of NOLs. Navigating Section 382, as well as other loss limitation provisions, enables maximum use of target's NOLs following a deal. Let's talk a bit more on Section 382. Very broadly, Code Section 382 limits the use of a target's NOLs following an ownership change, which is, subject to a series of special rules, generally a change in ownership of over 50% of the target stock by value during a 3-year period. Thus, Section 382 generally applies in the typical acquisition of target stock by buyer from seller. In this case, the target company's NOLs that may offset post-acquisition taxable income are generally limited each year to an amount equal to the target stock value at the time of the deal, multiplied by a long-term tax-exempt rate. This rate is relatively low and can significantly restrict the use of post-acquisition NOLs. Further, a lower target equity value will also serve to limit post-deal NOL usage under this formula. Fortunately, there are ways to increase the 382 limitation. For example, the limitation may be increased by certain built-in gains in the target's assets at the time of closing. In the bankruptcy context, if the target's shareholders and certain historic creditors own 50% or more of target stock after recapitalization, the target can, generally, elect either to use its NOL carryforwards, subject to certain reductions, without 382 limitation, or increase the 382 limitation on its NOLs by using an increased value for the target as a result of cancellation of creditors' claims. Strategic planning is critical to maximizing NOL availability and usage. Notably, Section 382 applies in more than just the case of a 100% stock acquisition. The limitation can be triggered, for example, through additional equity investments in a target or a target recapitalization. A distressed company needs to be aware of its changing capital structure to preserve use of its NOLs. Indeed, some public companies have even taken to creating poison pills to prevent ownership changes that would trigger the 382 limitation on their net operating losses. So what are the takeaways? NOLs are valuable assets in the distressed M&A context. In an asset deal, they may reduce gain to a seller, and an asset deal gives a buyer a basis step-up. In a stock deal, NOLs may, subject to limitation, reduce a buyer's tax burden going forward, and thus a seller may want to be paid for this benefit. Maximizing the availability of NOLs requires awareness of ownership structure and changes. Strategic planning can enhance the value of these attributes.